The owner takes some money out of their own business. Sounds harmless, right? Yet it is the most failed question in the entire bookkeeping exam. When the owner takes cash or goods out for personal use, that withdrawal is called drawings, and it always gets its own account in the books. Here is the trap that catches everyone. Drawings are never an expense. They never appear as a business cost on any statement, ever. Expenses are money spent running the business, while drawings return part of the owner's stake. Different job, different account. So drawings reduce capital instead. Remember the equation: assets equal liabilities plus capital, always. Now watch it happen. Say the owner takes £500 in cash. Assets fall by that amount, capital falls by the same, and the equation stays balanced. In the ledger, this becomes two entries: debit the drawings account and credit the bank, because DebtClick says a rise in drawings means debit. So whenever the owner takes anything at all out of the business, think drawings, think debit, and watch the owner's capital quietly shrink away. Sapera College offers accredited AAT courses taught fully online by real tutors, so you can study from anywhere with the link below.